All right, so I'm going to start off with some long-term charts. This is a weekly chart, 200-week moving average here. You can see price got stretched way too far above the 200-week moving average. We had a correction back down to it, but a stretch this extreme to the upside, it's going to need to do one of two things. It either needs to go a proportional distance below, so it needs to slingshot below it, or it's going to have to go sideways for a long time to work that off. It looks to me like we're probably stuck in a sideways pattern probably for a couple more years, and we may have to test or even maybe break below these lows at the next 4-year cycle low. So we've got a potential top here. This is the first real counter trend rally once the bear market started. This was this was one potential spot for this rally to stop. This is a bull market, but I think it's a bull market within the context of probably a longer term bear market that will end maybe when we get our next 4-year cycle low. So anyway, one potential spot for top, second potential. It looks to me like this is probably where it's topped. I have my doubts that the market is going to be able to recover and get back above this. It is almost certainly not going to be able to produce a sustained move above this peak, not during this 4-year cycle. We got a very similar look in the NASDAQ composite. The NASDAQ got stretched even further above the long-term mean than the S&P. It did drop slightly below it, but not what I would really like to see to produce the kind of a sustained move that could get above these highs and make a sustained higher high. So within striking distance of this resistance zone. And now let me go to the daily charts. All right, we've got that same look on the daily charts, just stretched way too far above the 200-day moving average. I don't believe that this, I think this is probably the A wave down. This is a B wave bounce, and we're now trying to start the C wave decline that will finish this ICL. Almost all intermediate declines unfold as an ABC pattern unless you just get a major crash. We had the potential for a major crash right here, but I think the Fed stopped it. I think they flooded the market. They're panicked about the banking stocks. They don't want the banking stocks making lower lows. So it looks to me like we may have topped here on this B wave bounce, and we're probably starting the C wave down. This has time to where it could go all the way out into October. So the Fed's probably going to fight this the whole way. So it's likely to be a very erratic back and forth move. And we get a final bottom, I would say probably early October. All right, so here are the warning signs. The transports have made a lower low. They're probably leading. And the banking stocks have also made a lower low. And like I said, the Fed is going to fight tooth and nail to try and prevent the banks from making lower lows. Widen this just a touch. They don't want the banking stocks dropping below these May lows. That would almost certainly include some more bank failures. So they're panicked to protect these banking stocks, and so they're going to fight this tooth and nail. I think that's why they how they stopped that initial what was turning into a crash. They stopped that crash and got a little bounce, but the bounce appears to be over. It's certainly over in the transports and the banking stocks. They've now made lower lows, and I doubt that they're going to be able to recover from this and come back up and make higher highs. And let me widen this. And with the rest of the market bottomed back here in October, and you can see the banks continued lower. You cannot have a sustained bull market without the banks participating. So this was a rally that was never going to give us a sustained breakout above the January 22 highs. All right, so an intermediate decline should retrace at least to the 38% retracement, and this did not do that, which is another sign that tells me this is probably not over. And a market that's been stretched this far above the 200-day moving average probably has to get much closer to the 200. I'm going to guess that we probably need to come back down to this 50% retracement, get a lot closer to this 200-day moving average. And if we can do that, then I think we will have a tradable rally, but I'm not convinced that it's going to make higher highs above this. I think this cyclical bull market may be over, and we may be setting up for the next recession, and I'll show you what I think could trigger this. But anyway, if this does fight off the efforts to prop it up, and we do get a move back down to at least this 50% retracement, and the banks come down and make a lower low, then the Fed is going to panic. All right, so just a rough guess. Like I said, they're going to fight this the whole way down because they don't want those banks making lower lows. So this could be a very erratic, very hard to hold on to, like short positions. But ultimately, I would like to see at least a retrace back to the 30 or the 50% retracement. Maybe this pivot here would be a support zone just a little below 4,200. If this happens, and if the banks are making lower lows, the Fed's going to panic. They're going to print a bunch of money, and that should give us a tradable rally in the stock market. But the problem is, and let me show you where the real problem is going to be. Oil and the commodity complex in general, it's put in its 3-year cycle low back here, and we're starting to come out of that 3-year cycle low. So the second phase of inflation is starting to heat up. My feeling is that this is probably a big cup and handle pattern that's forming. And if the Fed starts to print a bunch of money to rescue the banks and the stock market, a lot of that liquidity is not going to stick in the stock market and the banking indexes where they want it. It's going to flow into the commodity complexes that aren't stretched too far above their moving averages, and especially the oil market. And it's probably going to drive oil. It's going to complete the right side of this cup. So, here's the left side of the cup. We got this long basing pattern here. I think this long base here is kind of finished, and we're starting to get some upward momentum to drive this the right side of the cup, and that is going to be it's going to create inflation. It's going to collapse the economy, and it's going to create the next recession. All right, this is the CRB. This was our 3-year cycle low, so we're in the advancing phase of this 3-year cycle. And so if the Fed panics and they start to print a bunch of money, and that all that liquidity doesn't really stick in the stock market and the banking stocks and starts to flow into commodities, then it's gonna really ignite the second phase of inflation, and ultimately that's what creates recessions. Inflation is a tax on the middle class and the lower class, and when it gets too high, middle and lower class spending collapses, and then you start the recession. So if we can finish this C-wave decline, it's going to panic the Fed. They're going to print money. It'll give us a tradable rally in stocks. I doubt that the stocks are going to make higher highs, and certainly it seems very unlikely they're going to test the 22 highs, but I do think it's going to push the commodity complex higher. It'll probably give us that breakout in gold above 2100, and it's probably going to push oil up and the CRB to probably at least test these highs, and I would say a good chance of breaking out above these highs, and then we'll probably have our recession maybe late next year or early in 25. All right, and then one more cautionary sign. This is the semiconductor index. This has been the leading sector, and we've just got gaps everywhere in this chart. Gaps up and gaps down. That's a sign of emotional trading, and that probably is a sign of a top. So I'm kind of the opinion that the cyclical bull market has probably topped. If we can finish this ICL, we should get a tradable bounce, but I would not make plans that we're going to get a big breakout in a sustained move before the next recession and the next 4-year cycle low, which could drop. If the Fed prints too much money and they spike the commodity complex, create too much inflation, then we could get a move below the March 2020 low during that next 4-year cycle low. So a lot of warning signs here. I don't think you want to be pushing the long side in stocks unless we complete and finish this ICL, which looks like it may be starting.